I mean, it's 2025. Do you actually need a financial advisor to invest? Do you need an advisor today? If yes, how do you pick one? How do you know how you pay them? How do you know if what you're paying them is worth it? Today in this video, I want to talk to you exactly about those questions. If you're new here, my name is Soho Fini. I'm a certified financial planner and a private wealth advisor. And today, I want to talk to you about a couple of very important questions. Do I need an advisor in 2025? How do I pick one? How do I know how they get paid? And how do I know if what I'm paying them is worth it? Goes without saying, all the stuff we're going to talk about today is for education and entertainment. I really intend to give you some ideas to think about, but none of this is financial advice to you because I know nothing about you. So let's get into this. The first question, do I actually need a financial advisor today? And I think to answer that, let's go with this answer. For what? What is it that you think you might need a financial advisor for? Because you definitely don't need an advisor to get access to investments such as stocks or public investments. I mean, if we go back a few decades, in the 70s and 80s, for example, there was somebody who would call you on the phone, who was your stockbroker, and would say, hey, I have come across a great idea. I think you should invest some money into it. This person was responsible for introducing you to investment opportunities. Like, you actually needed a person to even get access to investments. Today, that job does not exist at all. You do not need somebody to call you to tell you I've come across this great investment idea, this new stock, and you should put money into it. So that's not what you need an advisor for anymore. In fact, today, most people are primarily investing in broad market ETFs and mutual funds. It has become very clear to them that picking stocks in the long term is not a very viable and successful, repeatable strategy to build great long-term returns. So that's not what you need an advisor for. So what is it that you might need a financial advisor for? To help you understand that better, I want to introduce you to a study that's been going on for 25 years that's been conducted by Vanguard, of all companies. And Vanguard, if you don't know about them, they are the leader of low-cost investing. And I love that Vanguard is the one that puts this out because a lot of people think Vanguard low-cost means you should not pay for advisor fees. The study is called Advisors Alpha. If you don't know the terminology, alpha, loosely put, in the world of portfolio management, is a term that is used to define the added value in terms of return that an advisor brings to the table on top of the market returns. So if the stock market does 10% and your advisor gets you 11%, then their alpha is an added 1%. So Vanguard came around in 2001, and at that time they established a framework. And at that time it was really limited to 4 major categories of the added value that an advisor would bring to the table. They defined them as asset allocation and investment selection, financial planning and wealth management, practice management and client experience, and behavioral coaching. That is how they defined it at that point. And about 10, 11 years later, they updated this. And in 2014, they published their findings and they said, you know what, we think the framework that an advisor brings to the table is a little more expansive. It's actually 8 distinctive categories where an advisor can bring value to the client on top of what the general market would be able to deliver to them. And they defined them as suitable asset allocation, investment selection, rebalancing, behavioral coaching, asset location, tax efficient retirement strategy, total return versus income investing, and tax loss harvesting. So to define these 8 categories, and this is where it gets interesting, they ultimately concluded that an advisor can add up to 3%, in some cases more, of net returns to the client's portfolio. 3% is so substantial. To give you a numeric example, if you were to invest $100,000 today, let it for 20 years, and it did 6%, it would be worth about $320,000. If you were to invest $100,000 for 20 years and it got a 9% return, it would be worth $560,000. So 3% is very substantial in terms of actual returns over a long period of time. What's really interesting to me, what's really the most eye-opening, is that Vanguard assigned the most value of these categories to behavioral coaching, tax loss harvesting, and tax efficient strategies, followed by investment selection. This is so interesting because it goes to show us that the real value of a very good advisor is so much on the softer qualities, not so much on a very crazy investment strategy or a sophisticated trading algorithm, but more so, can they behaviorally guide you through various market circumstances? Can they give you good tax advice? Because if they can help you save on taxes, you're already getting a better post-tax return, and that by its own is some added money in your pocket. And Vanguard has continued to expand this study, and these studies have remained true 25 years later. I'll actually link this study below for you. It's a public study. It's not a short study, but it's definitely worth a read. With that in mind, here's a question of, do you actually need a financial advisor? My belief is that if you are taking any risk with your money, you have earned money and you're trying to do things with it, make financial decisions with it that in some ways could be irrevocable, I think it's important for you to consult somebody and talk to somebody before making these decisions. But this somebody needs to have some very unique qualities, meaning while you can talk in passing with friends and family, I think the person that you really get advice from should have some very unique qualities. Number one is that they need to be a fiduciary, and need to be a fiduciary all the time. The term fiduciary in the world of finance ultimately means that this person has a responsibility to act in your best interest all the time. Okay, and it's so important for you to make sure, and I keep using the term all the time, is because there are advisors and financial professionals that are fiduciaries only some of the time and relevant to particular financial products. So you need an advisor who is a fiduciary all the time. For example, all certified financial planners or CFPs are fiduciaries all the time. Number two, this person needs to have a very good understanding and baseline understanding of your circumstances currently and your goals before they give you any advice. And for that reason, a conversation over drinks with friends or a family friend that really means well but knows very little about you, their advice might not be that helpful to you in the long term. I also want to add that sometimes, especially as younger people, we get advice from some of our older family members and friends and colleagues who we very much respect, and they really mean well, but they tend to give us advice that's just not that relevant for the time that we are trying to build wealth. And number three, this person needs to be working with people just like you on a regular basis. The truth of it is, and this is coming from my first-hand experience, is that the needs of different clients changes the capabilities of the advisor. So it's very important for you to work with a wealth advisor, financial planner, and a financial professional that works with people like you, with your needs and with your issues on a regular basis. They need to be very well versed in the type of problems that you are dealing with. With that in mind, I want to last but not least introduce you to some of the most common ways that people use the title financial advisor. And I think it's important for you to understand that not all the people who use a title financial advisor do the same things, have the same responsibilities, and get paid in the same way. Here's what I mean by that. If you go to the marketplace today as a client and look for advice with liability, meaning somebody at some level would be on the hook for the advice that they give you, you would be talking to a wide range of people who all loosely use the title financial advisor. 90+% of the conversation you have is with one of these three people: flat fee financial planners, money managers, and insurance professionals. And all three of these camps can loosely use the title financial advisor. Let's define those and talk about some pros and cons. The first group, flat fee financial planners, tend to be certified financial planners that charge a flat dollar amount, typically on an annual basis, to provide you with a very detailed analysis of your current circumstances and provide you recommendations based on those. They tend to cover most pillars of financial planning, from cash flow analysis to investment planning, retirement planning, insurance planning, estate planning, and so forth. What's good about this type of relationship is that it's fiduciary and you get completely non-biased advice. They tell you what needs to be doing, and you need to go implement those strategies on your own. And this is where perhaps some of the drawbacks come in. The drawback is that the flat fee financial planners are not involved usually with implementation of strategy. A lot of them are not even investment licensed to actually manage money on your behalf. So you have to take the recommendation, which tends to be good recommendations, and go find ways to implement them. You need to go and open the investment account or hire a money manager to open that investment account for you. You need to go pursue the insurances on your own. And one of the things that we know, one of the things that the Vanguard study also confirms, is that the behavior coaching and the help with the implementation on a consistent basis is absolutely key in order for you to get your money's worth. So the good thing about the flat fee relationship is that you get completely unbiased, comprehensive fiduciary advice. The drawback is they're typically not involved with implementation, and if they are, it's only in the very beginning, so the ongoing supervision is very, very limited. The second camp are traditionally money managers. I think this is what most people think of when they think of financial advisors. Okay, these are people who are big investment management firms or independent registered investment advisory firms, or RIAs, and they are involved in the business of managing money. You typically turn over a 6 or 7-digit sum of money to them, and their focus in the relationship is growth of that portfolio. They either charge commissions, which is less frequent today, or typically a management fee. Could be 1%, 0.5%, 1.5%, sometimes it's more than that. The limitation of this type of relationship across the board is that because it is driven by growth of the portfolio, management of a portfolio, typically the other aspects of financial planning, like risk management, tax mitigation, what you're doing in a real estate portfolio, your estate planning, are very much on the back burner, and a lot of times very much ignored. So that's a huge limitation. Last but not least are insurance professionals or insurance agents who also use the title financial advisor. These are the people who are exclusively licensed to handle insurance products like life insurance policies and annuities. And while they have a good understanding of risk management, they have massive limitations in the type of products they can offer to you. You're also the most likely to come across a lot of amateur talent in this space because the world of insurance has a much lower barrier to entry. So a lot of people who you interact with who come from the insurance world are actually relatively new to that space. So for that reason, you're going to find yourself in a relationship that's primarily and almost exclusively talks about insurances and ignores the other aspects of your financial life. So as you can imagine, if that's 90% of what's out there, most people have overall dissatisfying financial relationships. Is that some aspect of it is getting addressed, some of it is not getting addressed, a lot of it is getting ignored, or getting paid, they're paying for some stuff, but are unclear for what they're paying for. And that, I think, leaves room for the last 10% of truly comprehensive financial planning relationships. This is where I believe the most value is delivered to our clients, which are fee-based financial advisors and financial planners. These are the individuals that have the capabilities to manage money and handle insurance products, but they do all of those within the confines of a comprehensive financial plan. So they typically engage with you first and foremost in a consulting-based relationship. They generally charge a flat fee to build a plan for you. And at that point, you can make a choice of if you want them to implement the plan, the strategy, the insurance products for you, or if you would like to take the recommendations and go implement on their own. One of the examples I use for clients to help them understand this more is, imagine you're trying to build a home and you go to an architecture firm. The architecture firm draws the blueprint for the home you want to build. Now, at that point, you have the option to potentially hire this firm to actually do the build for you, or you can take the blueprint and go find your own builder. And that's ultimately what the fee-based financial planning relationship look like, is that they're draw the plan for you, and you have a choice to say, I want you guys to implement this for me, or thank you for your work and for advice. I'm going to take these recommendations and go implement on my own. With that being said, I hope you found this video to be helpful. I hope this brought up some questions for you. I hope you go ask your financial advisor, your financial professional, how they get paid, what their specialty is, and confirm that they work with people like you on a regular basis. If you found this to be helpful, like and subscribe, and until next time, thank you.